Hello, Merry Christmas, and welcome to Multifamily Investing with Bob Biggins. We've got a decorated studio today, very festive for Christmas. Today, episode number 34, we're going to talk about creative financing in multifamily. We're going to talk about 6 different methodologies, some being used more frequently, some being used less frequently, some with multifamily deals more so, and some with maybe fix and flips and smaller properties. Well, we're going to start out with the first one called Subject To. You've probably seen courses out there. Pace Morby has a course out there for Subject To. And that's really where the buyer gets the deed and the seller pays the mortgage. The buyer pays the seller pays the mortgage. Now, there's potential pitfalls there if the seller doesn't pay the mortgage, if the seller just pockets the money. So you have to have a pretty solid relationship with the seller there. It is a creative way to do it. It's more so done with probably single family homes and small multis, not so much with large multis, because banks are very attuned to what's going on with large multis. And so really the buyer gets the deed and the seller just keeps paying the mortgage. They may have a great interest rate, and then at some point in time, they either pay it off or have a balloon payment or have some type of an arrangement. But that's what's called a subject to deal, subject to financing. Second one is private money lending, and that's simply you just borrow money from friends and family, individuals, not loan sharks or anything like that at this point. You're just going to borrow money for either the down payment, or if you pay cash for a deal and then fix and flip it or rehab it for a refinance, then you pay your investors or your friends or your family back. There's joint ventures. Those are frequently done in multifamily. That's where partners will pool their funds together. Oftentimes they're all active partners. They just maybe call it a partnership, but it's also called a joint venture. There's probably legal differences between partnership and joint ventures, but in essence, you get a group of people, small group, maybe 2, 4, 6 people get pulled together and they take down a deal together. They just pool their funds and take down a larger deal than they can do by themselves. You've got hard money loans or bridge financing. Hard money is when you do go to a loan shark type person or an entity or a business, and they'll just lend you money for the down payment. And that may be before you fix up a property, or it may be to get the capital to fix up a property. And bridge financing, often with a bank, is done, or a lender of some sort, is done for maybe a 6 to 24 month period. Generally, these are at quite high interest rates. That's why they're less desirable. But if you need cash quick, you need to do a big rehab on a multifamily, and you think that the rents will support the improved value, then so be it. Take the risk, and it is risky, and sometimes they're variable, the rates, and they could go higher. But take the risk and give it a try. What's become quite common in the last few years is syndications. And that is where, again, investors, you have generally a general partner who will work to pull funds together from other investors. And there's what's called a Reg C and a Reg D. Now, a Reg C is much more methodical, and it is where you have to have the SEC, the Securities and Exchange Commission, pulled in, and it becomes a security, a marketable security. It's not as daunting as you would think. You just have to hire an attorney, an SEC attorney, and they will draw up the documents, and you just have to follow the bylaws of the documents. Now, Reg D is taxed like a safe harbor carve-out or exception for private offerings. They often call this the friends and family offering. This is where everyone, to be allowed to do this carve-out, everyone has to be active in the business, meaning they have to be either a property manager, they have to be a scout the deals, they have to work on the financing of the deals. Everyone has to have a job here, and one can be a capital raiser, but a capital raiser can't be their only job. That's what the SEC says, is that one job of being a capital raiser can't be your only thing that you do as a member of the Reg D team that would be taking down an asset. Now, what I'll talk the most about, and is the most common, especially with larger and smaller deals, is just plain seller finance. That's where the current owner is the bank. They can be the bank in many different facets. And you pay them direct. You pay them just like they're the bank. It can be called a private money mortgage. It can be called a land contract. It can be called an owner carry. And it has many different styles, but it can be for the down payment. It can be for the mortgage itself. It can be for the whole deal. You can have no down payment. It's less common, but you can have no down payment at all. And they're just financing the whole deal. And that would be maybe if the place is in very bad shape and you just tell the owner that I need the capital to make this place livable again, if it's in really bad shape, oftentimes. And the owner's happy because if they get it back, it's in better shape than when they started. So how do you do this? Well, you propose this to the seller in your buy-sell agreement or in your purchase and sale agreement, or in your either buy-sell agreement if you're doing MLS listings or small multi, or if you're doing a larger multi, that's in your LOI. You're just going to detail out everything, and if they approve, then that would get transferred into the purchase and sale agreement contract. And you would need to establish the down payment, the interest rate, amortization terms. Is it going to be a 30-year, 15-year, 20-year AM, 25-year AM? The financing terms, is it going to be for 5 years, 2 years, 1 year, 72 months, 48 months? What's it going to be? And then at some point, there's probably going to be a balloon payment, either of the down payment amount. So you can maybe finance 20% the seller take back, they call that. And you go get a bank loan for 80%. And so you bring nothing to the table. The owner spots you the 20%, for example, and then you take a bank loan for 80%, you have no money in the deal. And that way you can have the money that you do have to do any improvements you need to, and then pay that seller back after 2 years, 3 years, 5 years, whatever. Or if you have some cash, or you have partners that have cash, or you have investors that have cash, or you have access to cash, or you have a line of credit, you can put the 20% down, for example, and then the seller can take back 80%. I have 2 deals going right now. I've done one way, one the other way. I've got them. They're both where I'm paying sellers direct as we speak. And I've done it many times over the course of my career. So the person acts as the bank, and you pay them the 80% mortgage every month. And so again, that has very little or no money out of your pocket. And some of the technicalities is the seller will generally, they don't have to by law, but they will generally give you a 1098, which details out all the interest that you have paid them throughout the year, and they will send out the IRS. You will claim that on your taxes as interest, and they will tell the IRS that I've gotten this revenue as simple interest payments or compound interest payments or whatever, that they have interest income in the form of 1098. That's only if that's your primary business, or if it is over, and it's over $600. Well, it'll probably be over $600, but if it's not your primary source of business, then you do not have to do a 1098. The only time you have to do a 1098 is if you're a flipper, or that is your business, or you're a hard money lender, you're a lender of some sort. You have to provide 1098s for the interest that you received. So those are just a few ways, and just a real brief discussion on creative financing techniques. Be sure to reach out to me or Amy at any point. Biggins Team Realty, bigginsteam.com. We can explain all these to you. We can structure deals that way. Thanks for your time. I do appreciate it because I understand your time is very precious, and listening to this YouTube video did take some time. And so I will now say Bob Biggins, signing out.